Broadcasting from Washington, D.C., this is Insider's Guide to Energy.
Welcome to Insider's Guide to Energy. I'm your host, Chris Sass, and with me is my co-host, Jeff McAulay. Jeff, how's it going today?
Wonderful, Chris. Conference season is back in swing. Had a little bit of travel last week, back in Boston now, but great to get out there and have energy-themed conversations as always. How about you?
Same with you. I've been at trade shows for the last few weeks. Happy to be back here in DC. It's great to be on the podcast, and it's great to be talking about finance and energy. I mean, these things tend to go together, so I'm looking forward to having another good conversation. Do you have any expectations or things that you want to learn out of today's episode?
Gosh, well, I've never created an energy index that is tradable, so I'm looking to learn everything about that. Definitely an interesting topic, and I'm expecting we'll learn a ton today.
All right, well, let's bring on Timothy Kramer, the CEO and founder of CNIC. Timothy, welcome to the program. So to kick off, I always like to say, I think Jeff let the cat out of the bag of what you've done, but maybe start with the Cliff Note version of what your role is and then what problem you set out to solve.
Sure. So I am the founder and the CEO of a company called CNIC, which stands for Carbon Neutral Investment Company. And the opportunity that we saw is we just kind of phrase it as the electrification of America. And so with, the ESG tailwinds and the US going towards like 100% renewable grid and everything flipping over to electric, we took a look and said, wow, on a retail notional basis, electricity is the most consumed commodity in the US. But it wasn't in any index. It wasn't in any mutual fund, no ETF, nothing. And so, we thought we saw an opportunity here to kind of create an index and then try to launch some products that are benchmarked in the index and then see what happens.
So did you feel, you saw that there was not one existing. What made you understand that the need for that? Why is there demand for that?
So if you take a look at, there's other commodity indexes, right? So there's like the BCOM, the Bloomberg Commodity Index, which has 24 different commodities. There's the Goldman Sachs Commodity Index, the GSCI. It's got 24 different commodities. And there's like $800 billion or more that's indexed to those things. And so it just didn't make any sense if you've got, energy commodities in those broad-based commodity indexes. And we jokingly, and I know it's not true, but we jokingly say that crude oil and natural gas are going to zero and electricity is going to the moon. Now, we know that's not the case, but if you look at like the EIA and the IEA numbers and the BNEF numbers, you've got, some scenarios where you're significantly lower on the consumption of crude and natty, down by like anywhere between 40 to 70% by 2035. And electricity is, just going to be exponentially higher. So that it didn't make any sense why it didn't exist in any of those products. And it just doesn't make any sense why it's going to be bigger and better with electricity and not to try to take advantage of that.
So, Timothy, help me understand this. So, you said most funds have some, single-digit percentage in commodities. That commodity basket will include energy commodities like oil and gas. But your point is it doesn't include electricity. And maybe historically that was okay because electricity was essentially correlated with oil and gas. But now it may not be. And looking into the future, it may not be. And to that extent, why not have electricity as a commodity in that 5% allocation of funds? Is that your position?
Perfectly said. That's a heck of a lot better than what I said. Thank you.
No, I'm learning from you. So this is really great. And why don't you think electricity has been a part of that commodity basket before?
So I guess the first reason is the very first commodity index was made like in 1978, but there was not a commercial product tied to that until like 1998. And that's because it took a while for people to understand that. And that first commodity index, they in essence mapped those individual commodities to inflation. And so it took a while for people to understand that with electricity, kind of where the disconnect was, is you really didn't have a really robust, viable trading market for electricity until like the early 2000s, until the advent of ICE, the Intercontinental Exchange. And then once that started to get traded more and exchange cleared, those things kind of make electricity a little bit more in the forefront. And then right now, we'll say starting like in 2018, and it's just getting bigger and better, just the big push towards everything in the US being electric. And then the ESG tailwinds, and then the US stated goal of being 100% carbon-free generation by 2035. All of those things just kind of heighten the awareness for this, and we think makes the right opportunity to do it now.
So a layman question. A lot of our electricity is still natural gas dependent, right? There's a lot of gas, there's still some coal, but so are we mature enough for this to stand of its own as opposed to tracking natural gas?
Well, the goal again is, 85% renewable by 2030, 100% renewable by 2035. The correlations between electricity and natural gas are kind of starting to break down somewhat. They're still, depending upon the time of the year and what locations you're looking at, it's somewhere between, we'll say, 60 and 80%. But we just go back to, kind of skating where the puck is going to be versus where the puck is now. So if you're not going to have any gas-fired or coal-fired generation in 2030 or 2035, then that relationship should probably be even less robust.
Great. And so help me understand why this is important. So the investors out there that have money allocated in commodities, what are they trying to do? What's the goal of having that 5% commodity exposure? And then how does electricity help achieve that goal?
Sure. So what you're looking for with that exposure is typically commodities are for inflation protection and then for portfolio diversification. So with respect to inflation protection, if you take a look at all the different commodities and what their relationship is to inflation, electricity is like the leader. So CPI comes out month after month and it's 2.5% electricity. And then the correlation of the monthly changes in CPI versus the changes in electricity prices, if you go back to like 2014, that correlation is like north of 85%. So that's there. And that's on the direct. There's also an indirect because, everything else that uses power that doesn't directly reflect that in the CPI or the numbers. So it's there for inflation protection. And then with respect to portfolio diversification, if you take a look at the correlation of the electricity index to stocks and bonds, it's like literally like 0.00. So it gives you what you're looking for in terms of inflation protection and portfolio diversification. The other aspect is, you've got people now talking about model portfolios. And so there was an article in the Journal a couple weeks ago that talked about, a 60-40 model portfolio. So, Mom and Pa Kramer, 60% stocks, 40% bonds. And they talked about how that portfolio was just been getting beat up recently. And so there's a movement afoot to see like a 60-35-5. So 60 stocks, 35 bonds, and then 5 commodities. So if you take a look and you backtest that, the 60-35-5 beats the 60-40. But if you do a 60-35-3-2 with 3 commodities and 2 electricity, that beats everything. So we think that you do get what you're looking for in terms of better risk-adjusted returns, along with the inflation protection and the portfolio diversification.
How does one go about creating an index, right? You kind of found a trouble spot or a statement that you wanted to solve. So what does it mean that you created an index, and then who's using the index?
So to create the index, what we did is we figured out, we kind of looked at it, reverse engineered it. So we thought, what would be commercially acceptable? And so rather than pick just like one location in the US, we decided to do a basket of 6 of the major traded power hubs in the US. And so that was kind of the first thing, is to make it a little bit more commercially appealing that way. And then the second thing is electricity is not storable. So when you take a look at the Bloomberg Commodity Index or the Goldman Sachs Commodity Index, they all invest in pretty much the first month, the prompt month of those 24 different commodities. And the problem with electricity is because it's not storable, as you would have to roll from one contract to another, that just got messy. So an example would be like the June ERCOT contract is $60, the July is 100, the August is 140, and then the September is 60 again. So if you're rolling, if you bought 60s, you got to sell those back out, and then you got to buy hundreds. Then you got to. So the seasonality just kind of made the rolls messy, and then the liquidity structure too. So not only did we do the 6 hubs, but we stretched them out over a 12-month period, so you could take advantage of the backwardation in the marketplace, because the power markets tend to be backwardated, which means that the longer dated months tend to be below where the current months are. So you would get positive roll yield on that, and then it would spread the liquidity out so that you wouldn't, flood one particular area with a bunch of buy orders at one time. So we did it to spread it across the U.S., spread it across a time tenor, and kind of take care of the seasonality and the liquidity aspects of it all at once. So that's kind of how we thought of it and how we created it, and then just sat down, put it together, and then went to go talk to ICE and showed them what we had, and they made a couple of tweaks to it, and here we are.
And when you think about the weighting of those different hubs geographically, what are you using for that? And then also diurnal, like is it on peak, off peak, or sort of round the clock when you think about pricing?
So what we did for the weights is we took a look at what the average annual consumption is for each one of those 6 hubs. And then we do like a 3-year average weight on that. And that's very similar to what the other commodities do when they figure out kind of what their weight should be inside of the basket. And we did that so we could be fungible with these other commodity indexes. So that's kind of how we got the weight piece of this.
So with the greening of, and electrification of everything and IRA and other government programs, is this somewhat predictable? Because we're looking at demand growth charts that are crazy right now. Recently, there's been a number of articles saying that the EV production, the motor vehicle manufacturers are saying they're not getting the demand they had thought in the market. So there's been a bit of a slowdown, a little bit that in production. But is this kind of a forcing function from government and policy to drive the prices in this, or is this really a market that's changing quite a bit?
It's a market that's changing pretty rapidly. A lot of the changes are, driven by either local or, government, et cetera. Some of the things that we point to is, I think it's like there's 9 states now, and I think New Jersey was the most recent one, that January 1st of 2035, you can't even sell a combustion engine in the state. A brand new one, that is. So you got all these states that are mandating, no new combustion engine cars. In New York State, no gas stove hookups anymore. And I think there's like 4 or 5 other states that followed with that. California passed a rule that by January 1st of 2035, no delivery trucks in the state can be gas powered. They have to all be electric. So there's just so many things that are coming through here in terms of people kind of recognizing what they think the impact is in the environment, and then what they'd like to see to try to force the issue in terms of everybody getting green or at least carbon neutral.
So then what drives the pricing so it's not always going up, right? I mean, there's probably, if what you said, there would just be a hockey stick curve at some point and it would just kind of rocket up. But the reality is probably not that. So what's driving fluctuation?
Well, I think that in terms of prices going up, the thing I like to point out right now is in the past, we'll say 4 weeks, you had like the New York offshore wind, you had Ørsted, and it was BP Equinor. And so Ørsted went back to New York State and said, hey, we're going to build wind for you offshore. And we hedged it forward at $110 a megawatt hour. Sorry, we're not profitable. We can't even break even until that gets raised to 140. And the BP Equinor, they moved their prices from, I think, like $118 up to like about $190. And that's because they've got rising interest rates. You've got, difficult access to labor, material cost, everything else. And so, I get the point where people are saying if we're going to be renewable, the marginal cost of that should be 0. But the guys that make that want to make a profit. And you still have issues with those particular things getting built and kind of what the escalating costs are on that.
Great. So if I understand the thesis and also electricity as a hedge separate from natural gas, it's the case in which electricity prices are rising, but natural gas is not the marginal pricing mechanism. The marginal price of electricity is not dictated by natural gas. If it was, then you'd be just as good just having natural gas in the commodity basket. So the scenario that you're designed for in some ways to help hedge is a case when electricity prices go up and natural gas prices are neutral or falling. And the case in which that happens is your expected zero marginal cost renewables end up being more expensive, supply chain, interest rates, etc., and or your demand continues to increase, electrification of everything. That's the general story?
It's the general one. Yeah, there's one more twist I'd put on that, and that is the renewables that you're getting right now versus the plants that you're retiring. The renewables aren't dispatchable, so you really can't load follow. You can't really vary the output. I mean, you get the wind when you get it, you get the solar when you get it. You can't control that. And so ERCOT right now, ERCOT just came back with, they're trying to do, I believe it's a low interest loan, like a 3% loan for 20 years. And there's some other tax breaks they're doing. They're trying to incentivize people to all of a sudden build peaking units, which primarily are going to be, gas-fired units. So they've recognized that with this push to these renewables, you've made the grid less stable. And they're going to look at putting on, some natural gas resources just, for the peak shaving. But when you do that, if that natural gas peaking plant only runs, pick a number, 20 hours a year, you're not really, you're priced into that marginal molecule, but there are a lot of other costs that go in there that make that much more expensive than that marginal molecule.
Right, exactly. Like the capital costs, if you're not operating.
OpEx, CapEx, everything else. So you do actually increase the cost of the marginal megawatt when you go to those peakers in that scenario. But generally what you said is pretty much spot on.
Mm-hmm. Is there a case for the opposite, where you might have high natural gas prices and low electricity prices? And I think that's what people may be more familiar with as the duck curve, where you have midday prices. This would only be an issue if it's more on peak than round the clock. But where you have excess solar production, for example, in California, and that may outweigh what happens in short-term price spikes for natural gas.
On a short-term basis, I think you can see that. And so on a short-term basis, the relationship between gas prices and power prices is like, the correlation is like sub 30%. So if I took a look at like what the day-ahead clearing prices are for power and the day-ahead clearing prices are for the correct gas location, so PJM and we'll say M3, et cetera. If I take a look at those correlations, they're like 20 or 30%. And so on an intraday basis, or like even like a very short term, like next day, maybe balance of the week type basis, those relationships break down. But the relationships stay strong, at least they've been strong when you take a look at the NYMEX, the exchange traded gas versus the exchange traded power. Those do stay strong. So you could see a relationship, and you're starting to see it now with what's going on, that kind of a breakdown, like higher gas prices and lower electricity prices. But again, you get some weird aberrations like today, right? The day ahead market for ERCOT, hour ending 8 was like $200. And then the real time market came in $37. And so it's, if you've got normal amounts of wind and normal amounts of solar and the load comes in as it's supposed to, you're good. But if you're missing one of those things, then that relationship between gas and power breaks down.
And how does grid scale storage play into this, right? So it may not be ubiquitous yet, but how is that formula going to change?
Sure. So the best thing to point to is ISO New England put out a report maybe about 9 months, a year ago, and they were saying that in order to have a 100% renewable grid, you would need to have pretty much 400% of what you think the peak is going to be. Plus, you'd have to have batteries that would last 8 hours and cover, I think they said, about 45% of what the peak load is. So there's some pretty big numbers to make that happen if you want to be 100% green and 100% of the batteries kind of filling on that peak. Merchant batteries right now, I still think they're not profitable in any part of the U.S. And so most of the batteries that you see getting built are done simply off of like RFPs or guys that want to check a regulatory box to say that they're X% storable.
Yeah, we are seeing some more, at least proposals for merchant batteries in ERCOT, but not sure how many of those are getting built. That would be a good follow-up topic. But either way, I think that makes the point of there's a potential decoupling between gas and electricity on the margin. If you hit what I like to call peaker parity between gas and battery, then you've just got there's more options in terms of how that marginal megawatt hour is priced. So I think that's interesting. And look, the takeaway from me, and you know all this better than we do, better than a lot of our listeners, I'm sure. It's complicated. We don't know necessarily, is electricity going to go up? Is it going to go down? And so for people who really get those mechanics, who are in the market, who are sophisticated traders, they can trade. There's lots of instruments, heat rate call options, all sorts of forwards and futures, regionally, temporarily resolved. They can do that. But what about the rest of us? What about the larger funds who don't want to get into the nitty gritty? What you're saying is, here's a tradable, and it's a ETF, right? So this is accessible on a retail basis for the all the way down to the armchair investor up to the largest funds in the world, where they don't have to get into this, and we don't have to pretend like we know, is it going to go up or down? Is it going to stay correlated or not? There's enough factors there where this is a way to hedge against whatever ends up happening.
Right. Yeah. So if you've got access to the futures market, if you're a speculator or a hedger, et cetera, that's the cleanest, most efficient way to express your view on this. But if you are a pension, if you're an endowment, high net worth, family office, et cetera, the only way that you can really express the view right now is in this product.
So I guess this begs a question. If this is such a great idea and it's so needed in the market, why didn't Bloomberg do it?
Bloomberg's the 800-pound gorilla in this space, so I got to be careful what I say. We've got a relationship with them. They're a good group. The sticking point came, I'd say, with the data, because ICE is the premier exchange and clearing mechanism for electricity futures, and so they've got the data, as well as all the clearing functions that go on there, and they've got their own index team. So, and ICE also owns the New York Stock Exchange, which is where the ETF is listed. So those things kind of fit together. I do think that other groups are looking at trying to figure something out here. We have an exclusive on the data and the index, so I think we're protected for a while. But I do think you will sometime in the future see some other products pop up.
So is this going to be mainstream then? Is this going to be in everybody's portfolio at some point in the future, you're thinking? I mean, this is early innings from what I see, right? So you've created this, you're just kind of working with some institutions to get this going. But do you see, if you turn the clock ahead 4 or 5 years, is this in everybody's pension fund type of thing?
Yeah, I would say that this is something, if you take a look again at the portfolio allocation, so, we'll say 60, 35, 3, 2, something like that. This is something that you should have a small percentage of your AUM allocated to, and then just, put it away, forget it. And that's what you see some of the pensions and endowments doing. They'll typically hold between like 3 to 5% of their AUM in commodities, and they just kind of leave it there. So we're not looking for, of the $800 billion that's tied to commodities, we're not looking for a 40% market share. It just doesn't make any sense for anybody to do that. We're just kind of playing for that, 2, 3, 5% of the commodity piece, or that 3%, or whatever the number would be for the personal investor.
Great. And Timothy, this is really fascinating. We dove right into the index and how it's constructed, but your facility with this conversation, both of energy trading and of indexes and how all this works, I'd love to hear more about your background, how your journey led you to this point, and especially the pieces of your experience that led you to have this idea or even know that it was possible to create such an index.
Sure. So before this, I worked for a private equity shop, and I was responsible for their commodity hedging for their infrastructure and their PE groups. And so that led to like a broader exposure to commodities. So it was, obviously electricity, natural gas, crude oil. It was interest rates. It was some metals, things like that. And I actually got my start in the capital markets back as a currency trader in the early to mid 90s, working for Lehman Brothers on Wall Street. So I always liked to look at like a bunch of different vehicles, not just one commodity. So in the back of my mind, I was always looking for an opportunity to try to figure something out that had like a kind of bigger, broader scope to it. And then just watching what was going on in the space as everybody was shifting towards the renewables and watching this trend, but there's just no vehicle for the public to use. And so that's kind of how I put the pieces together and said, look, I've done pretty much all these other commodities. I think I know what goes on. And so that's kind of how we started down the index path. We originally, it was just like, hey, let's start a hedge fund. And in the hedge fund world, they've got what I call like the rule of fives. They say you got to have $5 billion and get a 55% rate of return for 5 years. Otherwise, you don't matter. It's like, okay. So then we said, we're green. And then they said, okay, we'll talk to you, but you still got to have all those other requirements. And so we created the index because that at least gives something that people can look at. Because if you're trying to do a hedge fund, they go, well, what are your strategies? What do you do? And this. But with the index, it's rules-based. It's like, here you go, and it's published by ICE, not us. So that just kind of led a certain amount of credibility to what we were doing. And then that allowed us to kind of jumpstart the process a little bit faster to try to run some AUM off that.
That's great. And rather than having to try to know where power prices are going, you can surface an index, and if people are long power, they can buy it. If they're, I assume, if people want to short the index, they can. Is there going to be a short version of this too coming out, or are you sticking with the simple basket?
Yeah, you can short this if you want to. I mean, it's just a vehicle for you to express the view. So it just, in essence, if you think about it as electricity is now a commodity, where before people didn't really view it that way.
Yeah, absolutely. And so for our listeners who are intrigued by what they've heard, but maybe not all of it makes sense, what advice would you have for people who are trying to make sense of this? This is kind of a lot of new information. What's a great way for people to get up to speed on commodities, on index, on futures trading? How would you advise maybe earlier listeners if they're earlier in their career?
I tell them to go back and listen to all the podcasts that Chris and Jeff did, because they're a good source of education. Other than that, our website, CNICfunds.com, we try to put up a white paper once a month, and we keep them brief, like 5 pages or less, that address common questions that we get from people. And then we also post up, we try to do like a podcast once a month also, and we try to put those up there. So I think those things do a relatively good job of kind of filling in some of the basics. Again, this is very new, like we talked about. Not a lot of people have exposure to this. And so it does take a bit of time to get people comfortable with it. Yeah.
Yeah. Well, this is really fascinating, Timothy. I want to say this is one of the more unusual topics for me, but highlights a corner of the financial markets that I wasn't previously as familiar with. And it's really interesting to see what you're doing and unpack it a little bit. We don't usually have to give the disclaimer, but I suppose I have to say this is not legal, tax, or financial advice. We're not promoting any securities. Chris and I don't own any of this ETF, though it is intriguing. And Timothy, really just want to thank you for sharing your thoughts and expertise with us today. I know our audience really will appreciate it as well.
I appreciate you guys having me. Thanks again. This is a great opportunity.
For our audience, we hope you've enjoyed this educational journey. It's been educational for me. It wasn't a part of the business I've generally tracked, so it's been fun. If you like this content, don't forget to share it, subscribe, add comments, and follow us on YouTube. And we will see you again next time on Insider's Guide to Energy podcast. Bye-bye for now.